Picture this. You're driving a car that's on its last legs, and it finally gives up on you. Suddenly you're faced with a daunting question. How will you afford a new vehicle? It's a common scenario that many of us can relate to. And in these instances, we often turn to a financial solution that's been around for centuries. Loans. Loans can offer the financial boost you need, but with various types available. Which one is the right fit for your needs? In this situation, a loan might be your best bet. But what type of loan should you go for? Loans are simply borrowed money that you repay with interest. They are the financial fuel that powers many of our life's significant purchases, from the humble hatchback to the suburban dream house. In essence, a loan is a financial agreement between you and a lender. You receive an amount of money up front, and in return, you agree to pay back this amount, plus interest, over a set period of time. Loans can be an ally when managed correctly. They give us the ability to make big purchases or investments without having to wait years to save the full amount. Whether it's pursuing higher education, buying a car, or even starting a small business, loans can help us reach these milestones much faster. But remember, borrowing money is a responsibility. It's crucial to understand your commitment and to plan your repayments wisely. Now let's dive into the different types of loans. There are many types of loans, each with its own purpose and terms. Let's start with student loans. These are designed to help finance higher education. The great thing about student loans is that you don't have to start repaying them until after you've graduated. And some even offer income-based repayment plans. Next, we have mortgages. Simply put, a mortgage is a loan you take out to buy a home. We'll delve into the nitty-gritty of fixed and adjustable rate mortgages in a bit. Then there are auto loans, which help finance the purchase of vehicles. The vehicle you buy serves as collateral, meaning if you fail to pay back the loan, the lender can take your car. For budding entrepreneurs, small business loans can be instrumental in launching or growing a business. These loans can be used for anything from purchasing equipment to covering payroll during slow periods. Now, let's talk about payday loans. While they may seem like a quick fix in an emergency, they come with incredibly high interest rates and can lead to a cycle of debt. It's always wise to explore other options before resorting to payday loans. You see, each type of loan is like a tool in a toolbox. They all have their specific uses, and knowing when and how to use them can make all the difference. But remember, with every loan comes the responsibility to repay it. Each type of loan has its own unique advantages and disadvantages. That's why it's crucial to understand your options and choose wisely. In the next part of our journey through the world of loans, we'll take a closer look at the nuts and bolts of a loan, including the principal, interest rate, and term. So stick around, and let's continue to demystify the world of loans together. Every loan has three main components: the principal, interest rate, and term. Let's dive into these one at a time. First, the principal. This is the amount of money you borrow. If you're buying a car and you need $20,000, then your principal is $20,000. Simple enough, right? Now, onto the interest rate. This is the cost of borrowing money, expressed as a percentage of the principal. So, if your interest rate is 5%, for every $100 you borrow, you'll pay an extra $5. This is how lenders make their money. Finally, we have the term. This is the length of time you have to repay the loan. Terms can range from a few months to several decades, depending on the type of loan. The longer your term, the more interest you'll pay over time. But a longer term also means smaller monthly payments, which can make a loan more manageable. These three components work together to determine the overall cost of your loan. The principal is what you need up front. The interest rate is the cost of borrowing that money, and the term affects how much you'll pay each month and in total. Understanding these components will help you make informed decisions about loans. So, when you're considering a loan, don't just look at the monthly payment. Consider the principal, interest rate, and term to understand the true cost. Loans can be categorized as either secured or unsecured. Now, what does that mean exactly? Well, secured loans are those that require collateral. This could be a physical asset like a car or a house. The lender holds on to this collateral as a form of security. If you're unable to repay the loan, the lender has the right to take possession of this collateral. On the other hand, unsecured loans don't require any collateral. This might sound like a good deal, right? But remember, lenders aren't in the business of losing money. To account for the added risk they're taking, unsecured loans usually come with higher interest rates. So, which is better? It really depends on your situation. Secured loans often have lower interest rates because the lender has some form of security, hence the name. This can make them a more affordable option over the long term. However, they do come with the risk of losing your collateral if you can't make your repayments. Unsecured loans, while having higher interest rates, don't put any of your assets at risk. This might be a more suitable option if you don't have any assets to offer as collateral, or if you're uncomfortable with the idea of potentially losing your car or even your home. In the end, it's all about understanding your financial situation and making an informed decision. Secured loans aren't as scary as they might sound, especially with good planning. Several factors can affect the interest rate on your loan. Let's delve into some of these key elements that can influence the cost of borrowing. First up, we have your credit score. This three-digit number is like a financial report card, reflecting your creditworthiness based on your past borrowing and repayment behavior. A high credit score can unlock the door to lower interest rates as it reduces the lender's risk. Next, there's the loan amount. Generally, larger loans come with higher interest rates. This is because larger loans represent a bigger risk to the lender if you default. Then we have the term of the loan. Shorter terms often come with lower interest rates than longer ones. This is because the longer the term, the more uncertainty there is for the lender, resulting in a higher interest rate. In some cases, your employment status and income can also play a part. Stable employment and a high income can make you a less risky borrower, potentially leading to a lower interest rate. Remember, different lenders may weigh these factors differently, so it's important to shop around and compare loan offers. Knowing these factors can help you secure a better interest rate. So, the next time you're considering a loan, remember to check your credit score, consider the loan amount, and choose a term that's right for you. Your wallet will thank you. Sometimes, a cosigner can help you secure a loan. A cosigner is an individual who agrees to repay your loan if you default, essentially sharing the responsibility for the loan with you. But it's not all rosy. There are risks involved for the cosigner. If you miss payments or default, their credit history could take a hit, and they could be held legally responsible for the debt. So, having a cosigner is a serious commitment and should be considered carefully. Interest rates can either be fixed or variable. Now, a fixed interest rate is just that, fixed. It's the steady companion on your financial journey, never changing, not even by a hair's breadth. This consistency means your loan repayments are predictable, allowing for easier budgeting. However, the catch is that these rates can sometimes start off higher than their variable counterparts. On the other hand, variable interest rates are the wild cards of the loan world. They fluctuate over time, dancing to the tune of market conditions. They can start off lower, potentially saving you money in the short term. However, they can also increase, leading to potentially higher payments down the line. So, in the grand scheme of things, which is better? Well, it's not about better or worse, it's about what suits your needs and risk tolerance. Choosing between a fixed or variable rate depends on your financial situation and risk tolerance. Loans can be a powerful tool when used wisely. We've explored the landscape of loans from student to auto and mortgages to small business loans. We've dissected their components, weighed the pros and cons of secured versus unsecured loans, and delved into the factors affecting interest rates. We've also touched on the role of cosigners and the difference between fixed and variable interest rates. Remember, always do your research and consult a financial advisor before stepping into the world of loans. Thank you for watching. Stay tuned for more videos on personal finance topics. Before we wrap up this video, we want to remind you to be a part of our growing community. If you found this video helpful, don't forget to like it, share it with your friends and family who might be contemplating taking a loan, and subscribe to our channel for more videos on personal finance topics. We're here to help you make informed financial decisions. Your engagement helps us reach more people and empower them with the knowledge they need to navigate the world of finance. So, don't hesitate to leave a comment below if you have any questions or topics you'd like us to cover in future videos. See you in the next video.